Hey traders, Akil Stokes here, Chief Currency Analyst and Head Trading Coach over at TradingPower.com, and welcome back to another Forex Market Preview. I want to apologize in advance for no camera display, or if my energy is a little low. I am feeling pretty awful this weekend. Caught a little cold. It's also very early on Sunday morning, but I do have what I think is going to be a very informative Forex Market Preview for you, so I wanted to record it anyway. I think it's going to be pretty educational. Speaking of educational, big shout out and a big thank you for everyone that joined us for our Keystone event last week. Charles did a great job. As you know, I was sitting in there moderating as well. And from what I've seen, I've been teaching and coaching for about 5 years now. So we do a lot of these free events. From what I've seen, that was one of the most educated groups of traders that we've had, and not just educated, but hungry and focused. Typically, when we have these big live events and we bring in hundreds of people, you get some non-serious traders in there that like to disrupt. For the most part, everyone in there was focused on learning how to read a price chart, focused on the task at hand, and from your responses and your comments, it seemed like you guys were able to pick up the information pretty quickly, which is a great help for us and makes our job easy as educators. So I just want to say thank you guys for that. And if for some reason you missed it, if you forgot to sign up, or if you're new to this Forex channel, you're new to TradingPower.com, just head over to our website, TradingPower.com, click that Learn to Trade tab. There should be a little pop-up that comes up allowing you to enter your email address, and if you sign up in there, you will be notified the next time we host a live event. And I know we will be having a few of them before the year is over, so make sure you're on that list. Now, in today's video, I wanted to really follow up on last week's video. Last week, if you remember, we took a look at the Euro Aussie. We're looking at a potential structure-based trade and talking about how you can use structure not only to find potential entries in the market, but potential exits as well. Now, I recorded that video a little bit early, and I put in a little sign that says the trade possibility or the potential trade ended up being violated before the New York close. And I was reading through the comments, and I got a comment from one trader. I'm guessing he's a newer trader, maybe a struggling trader, and it was a comment about the entry technique. He was saying, so I need to babysit the market. If it is a double bottom entry, why not place a buy limit at the first order? And this is a great example of something that gets a lot of traders in trouble. Earlier in the week, I had a live trading blog where we were discussing a struggling trader that felt like he knew the information, but he couldn't quite put it together. And because of that, he was losing money in the market. It's the same thing here. A lot of traders only know enough to be a danger to themselves, meaning they're stuck in that one of the unconscious incompetence level of trading, and they think they know because they've seen stuff online, they've read stuff in books, but they don't know how to use it. However, instead of training themselves and making sure you're using it the right way, they rush into things and they end up making mistakes that could be detrimental to their account. A great example is again, for you guys that aren't familiar, there are 4 levels of trading. The first is called unconscious incompetence. That's you don't know what you don't know. Picture yourself being like a young child or a baby. I've got a soon-to-be 2-year-old kid at home, and he likes to watch me when I cook dinner. And, when I put the stove on, the burner turns red, and each time it turns red, he just sees, oh, it's red, I want to touch it, I want to touch it. Now, we're old enough to know that if you touch a hot stove, it's going to burn. It's going to hurt your hand. However, a young kid who has never experienced this before, they don't know the result of that type of action. And we call that unconscious incompetence stage the same thing. Traders think they know what they're doing, but they don't. And unfortunately, many of them get burnt. So I want to show you guys an example of why you don't want to place a limit order on a double bottom. And again, double bottoms, we use those as conservative entries. So if you remember, in this particular trade scenario, you can go back and watch last week's video if you'd like. in this particular trade scenario, we were looking at a potential structure-based buy right down here near these green arrows. Now, we also mentioned that on the higher time frame, we have what's called a descending triangle. A descending triangle is typically a sign that we're going to see a breakout to the downside, a bearish breakout. So it doesn't mean that you eliminate all opportunities to buy here at previous structure support. There are definitely some very good counter trend trading opportunities down there. However, what I mentioned is I want to be a little bit cautious with my approach because my idea is really going against what the higher time frames are saying, and I do want to take the higher time frame into account whenever I'm doing my trading. So in order to be safer, we wait for a more conservative reason for entry, and an example of a conservative reason for entry is a double bottom. In a double bottom, what you're waiting for the market to do is you're waiting for the market to come down. You're waiting for it to retest that initial level of support, right? Or structure, support or resistance if you're looking at double tops or double bottoms. In this case, you're looking for a price action to come down, retest that previous level of support, looking for that support to hold. You're looking for another test, so a second test of that support. And if that second test holds, then you want to get involved in the long entry. So essentially, you're waiting for the market to test that level 2 times before getting involved. Now, the problem is if you don't wait for that second test, right? If you just put a limit order there, so let's just say a trader, as this trader mentioned, why I don't want to babysit it, I just want to put a limit order there. If you put a limit order right here, what do you think? What do you think is a danger of what could happen? I'll pause the tape for a little bit and let you guys figure it out. But what is the negative side or the downside of just waiting or just putting a limit order there and trying to get involved before you have a confirmed double bottom? Yeah, exactly. The market can blow through. The market can blow right through, never confirming your double bottom, and now you're involved in a trade that you don't want to be in. And we saw the exact same thing on this chart. These are the notes that we had from last week. If you see right here, this is where we're looking for the double bottom. We saw our initial test right down here. We said, you know what? We have our initial test right here. RSI was oversold. We're waiting for the retracement. We got that. We're waiting for the second test. If we can get a second test that holds right here, we'll look to get involved long and trade it up towards our previous level of structure. Now, as I zoom in, you'll see this, and this is for you guys that watched the Keystone event, this is going to be familiar to you. What do you see on this second test? Do we have a hold or do we have a violation? Well, we have a violation. You can see price action puts in a lower low, lower close. Lower low, lower close tells us to expect a bearish continuation. And although the market retraces a little bit on the Sunday open, once the real traders get back in the market, you can see we just flush downwards, giving us what would be a losing trade for someone that entered aggressively. However, for someone that waited for those rules of a double bottom to be completed, they never would have been involved in a trade. They would have saved themselves some pips. And what I've learned in my experience is that, one of the easiest ways, and I guess easy is probably a bad word because I don't want to make it seem like trading is too easy, but one of the best ways to turn your trading around isn't necessarily by knowing more, adding new strategies, adding new techniques. It's really about eliminating small mistakes like this. And that's kind of how I turned my trading around. I remember I had started tracking my mistakes in trading, and I realized I was making maybe 15, 30 mistakes a month, and I started making process-based goals instead of outcome-based goals. What that means is instead of focusing on trying to make this much profit a month, I said, okay, I just want to trade correctly, and if I can eliminate one mistake a month, I'll be on the right path. And I made that my goal. And, it took some time, but as I started eliminating these small mistakes, I realized that I was actually becoming a much better trader, and my trading account started to reflect that. And if you just do the math on this, think about a mistake like this. Let's say you had a stop loss that was 25 pips away, right? So 25 pips, not a big stop loss at all, just an average stop loss, I guess, for if you're an hourly trader or whatnot. Let's say you're making one mistake a week, just one mistake a week. So you're costing yourself 25 pips in the market a week. due to a trade that you shouldn't be in. And that's the key part. I'm not talking about losing trades that meet the plan. That's going to happen. Every strategy and system loses. I'm talking about involving yourself in trades that you shouldn't be in the first place, kind of like this, because this is not a double bottom. So let's say you take a 25 pip loss on this. Let's say you make a mistake like that once a week, right? Once a week. That means you're costing yourself 100 pips a month for no reason. That means you're costing yourself 1,200 pips a year just off making trading mistakes. And I'm guessing many of you are making more than one trading mistake a month. But again, or more than one trading mistake a week. Again, one trading mistake a week is going to cost you, if you're averaging 25 pips, let's say you make it an easy number, that's going to cost you 1,200 pips a year. Now, let me ask you guys this. How many of you guys are even making 1,200 pips a year? Right? If you're making less than 1,200 pips a year, you're giving away more than what you're actually returning from the market just in mistakes. You know, for example, this year, Charles and I in the syndicate program, we've done about a little over 2,000 pips. We just had a rough week this week. We gave it back 113. But we're at about 2,287 pips. Right? Let's 2,287 pips. Right? If we were making mistakes, that's about a 45% return based off, we base our syndicate off a $10,000 account, trading a standard 2 mini lot position. So $2 per pips. So 2,287 pips, that's about a 45% return. If we were to give 1,200 of that back, right, we're essentially cutting our return in half. Right? We're going from about a 45% return to about a 21% return, something like that. All because of one mistake a week that is easily avoidable by just educating yourself and being knowledgeable about the market, right? Think about the big picture. So I urge you guys, a lot of you guys like to watch these videos. A lot of you guys like to watch different videos around the YouTube world and just implement whatever you're seeing right away. I did the same thing. I know how it is. I would watch something, I would write it down and be like, okay, I'm gonna do this next week in the market. Make sure you know what you're doing before you do it, right? Don't be so quick to trade live money while you're in that unconscious, incompetent stage where you think you know what you're doing, but you don't really know what you're doing because you only know enough to be a danger to yourself. So that's the message I wanted to get across in this week's Forex Market Preview. I know no new charts. Usually I give you guys a potential trade that's on my radar. But again, I'm not feeling too good, so I never want to do new analysis when my mind is not in the right place. But that's an easy mistake that you can fix. Hopefully, this trader that left the comment, hopefully he's watching this video, and hopefully this situation, hopefully it'll be an educational lesson for the future. Now, if you hang on, I'll throw in some bonus content from our syndicate program. This was another kind of a weird example on New Zealand dollar this past week. We had a debate. A lot of traders were looking at a potential cipher formation that wasn't really a cipher formation. I kind of broke down why it wasn't, and it's tricky. Sometimes you get funny candles. So I'll put that on to end out this week's lesson. But do me a favor, guys. You guys have been very supportive. Continue to like this video. Continue to subscribe. Continue to share this with a trading friend. We love doing this stuff, and we love sharing it with new traders. We had a lot of new traders in our Keystone event this week that said, hey, I'm just finding out about you guys for the first time because someone shared this on Twitter. So the more you guys share, the more traders that we can impact, the more, hopefully, the more traders we can help. That's the plan. But we appreciate everything you guys do. Again, I'll throw that syndicate clip on for the end of this video. And until next time, plan your trade your plan. I'm going to get some tea, some ginger, some lemon, pop some vitamins, and do everything I can do to be ready for tomorrow's private Q&A session. So have a great weekend, guys. As far as bigger perspective on the market goes. Now, here's what a lot of traders are doing. I know some of you guys are seeing a cipher formation in here. All right. If I just zoom this chart up as much as I can, you're seeing a cipher formation here. You're looking at something like this. You're seeing an X to A to B, B to C, and a CD completion somewhere up there. I'll draw it out with a better tool for you. Looking like this. X to A to B, B to C, C to D. And hopefully you haven't gotten involved yet. Now, I will tell you why this is not a cipher formation for me. 2 reasons. One, this red candle right here, this cannot be your A leg. So if you are taking your X leg right here down to this as your A leg and your B being the same candle, you cannot do that. That is not going to be a valid X to A, A to B, and I'll tell you why. If we go down to the hourly chart and you look closely, right, pay attention to how this candle formed. You just can't spot the highs and the lows. You got to be able to read price action. This kind of follows up on the Keystone trading event. You have to be able to read price action and know how the market ebbed and flowed. Now, I can view this right now and tell you that this isn't the retracement, but if you need help to make it clearer, go down to your lower time frame, go down to your hourly chart and take a look at what formed first. If you notice, right, price action came to here, right? All of this is that same candle. This high and this low is that same red candle in the 4-hour. Price action put in the high first before putting in the low, which means this. This is going to be your A leg. This is going to be your B leg, right? Does that make sense, guys? We're not in a live room, so you guys can't hear me, but hopefully that makes sense. Again, price action came here. We shot up. Then we shot down for this lower low, lower close. So this has to be your A leg right here. Again, going back to the 4-hour, it looks like the same candle, right? It looks like the same candle, but you cannot count this low because this low came after the retracement, which is going to make it an invalid cipher pattern or cipher formation. And technically, I mean, you can still have a cipher formation if you take this as your A leg right here. However, just be very careful with that. If we look at our Fibonacci's at that level, if we take our Fibonacci extension, we're going to have an invalid C leg, which you can see we're not going to meet our C leg requirements. I'm going to bring my 1414 in, wherever it's at. And you're going to see that we do have a break and close below the 1414, making that invalid. So again, I saw that. I posted an idea this morning, the Trading View. I saw that this morning from a few traders, and I figured, hey, you know, we have so many syndicate members. If there are a few traders out here doing it, some of you may be doing it as well. And hopefully this video reaches you in time so you don't have to make that mistake. And if you were someone that looked at this situation, you're like, Akil, it's weird. It's weird. I don't really know how to handle it. For the future, this will be a great training tool for how to go about breaking down that situation when you have something like what you see before you on the chart. So enjoy. Now, I did just do, if you guys check my personal YouTube page, Akil Stokes, I'll put it under the Trade Empowered YouTube page as well. There's a Akil Stokes playlist. I just did a blog post about our syndicate journey up to this point in the week, how it's really been a dogfight. So if you're interested in hearing about that, you can go over there and check it out. And I'll be following up on this topic.